Hello everyone, and welcome back to the channel. Today, we are diving deep into a subject that is the backbone of every UK business, UK payroll for the 2025-2026 tax year. Whether you're a business owner, a payroll professional, or just an employee curious about your payslip, this video is your comprehensive guide. We're going to break down every key component, from income tax and national insurance to statutory payments and RTI compliance. A quick but important note, the UK tax year runs from April 6, 2025 to April 5, 2026. As the official rates and thresholds for the new tax year haven't been finalized by HMRC yet, we'll be using the confirmed 2024-2025 figures as a baseline to demonstrate how everything works. Please always use the confirmed official tables when they are released in early 2025. Let's start with the two biggest deductions on any payslip: income tax and national insurance. Income tax is collected through the pay-as-you-earn system, or payee. This is simply the mechanism where your employer deducts tax directly from your wages before you get paid. The first and most crucial element of this is the personal allowance. For the 2024-2025 tax year, the standard personal allowance is $12,570. This is the amount of income you can earn each year completely tax-free. If your total annual income is less than this, you typically won't pay any income tax. For example, if you earn a salary of $30,000, you subtract the $12,570 allowance, leaving you with $17,430 of taxable income. Your tax code tells your employer how much personal allowance to give you. The standard code is 1257L. 125E7 represents the $12,870 allowance, just with the last digit dropped, and the L means you're entitled to the standard personal allowance. You might see other codes like K codes, which are used when you owe tax from previous years, or codes like BR for basic rate, which are common if you have a second job and your allowances are already used up. Once you subtract the personal allowance, your remaining income is taxed at different bands. For England, Wales, and Northern Ireland, the basic rate of 20% applies to taxable income up to $37,700. The higher rate of 40% kicks in for income between $37,701 and $125,140. Anything earned over that is taxed at the additional rate of 45%. Now this is crucial. Scotland has its own income tax system with different bands and rates. For the last tax year, Scotland had 6 tax bands, with a lower threshold for hitting the higher rate. So always make sure you are using the correct tables based on the employee's residence. Let's move on to national insurance contributions, or NICs. This is the second mandatory deduction. While income tax funds public services generally, NICs are specifically tied to your entitlement to certain state benefits, like the state pension and maternity allowance. For employees, this is called Class 1 primary national insurance. It's calculated based on your earnings in each pay period. There are a few key thresholds. The lower earnings limit is the point at which you start building up your qualifying years for state benefits. The primary threshold is the point at which you actually start paying national insurance contributions. Finally, there's the upper earnings limit, where the rate of NI you pay drops significantly. Using the 2024-2025 figures as our baseline, you pay an 8% rate on earnings between the primary threshold, which is $12,570 per year, and the upper earnings limit of $50,270 per year. For any earnings above that $50,270 mark, the rate drops to just 2%. Employers also pay NICs, known as the secondary contribution. They start paying once an employee earns above the secondary threshold, and the rate is typically 13.8% on all earnings above that point. But here's a crucial point for small businesses: the employment allowance. Small employers can claim up to $5,000 off their annual employer's NIC's bill. If you're running a small business, make sure you are using this benefit to reduce your payroll costs. The UK payroll system is centered on real-time information, or RTI. This means you must report deductions and pay information to HMRC on or before every single time you pay your employees. The main report you send is called a Full Payment Submission, or FPS. It contains all the necessary figures: gross pay, tax, NI, statutory pay, and starter or leaver dates. There's also an Employer Payment Summary, or EPS. This is sent monthly, but only when you need to claim reductions to the amount you owe HMRC, such as for the employment allowance or for recoverable statutory payments like maternity pay, which we'll get to in a moment. You must then pay the total tax and NI liability to HMRC by the 19th of the following month or the 22nd if you pay electronically. Next up are statutory payments. Employers are responsible for administering and paying several types of statutory leave pay. First, there's statutory sick pay, or SSP. To be eligible, employees must earn above the lower earnings limit and have been sick for 4 or more calendar days in a row. The baseline rate for 2024 and 2025 was around $116.75 per week, paid for up to 28 weeks. Then we have statutory maternity and paternity pay. For SMP, the first 6 weeks are paid at 90% of the employee's average weekly earnings. The remaining 33 weeks are paid at the standard rate, which was about $184 per week, or 90% of their average earnings if that is lower. For SPP, it's a similar calculation, paid at the standard rate, or 90% of average earnings. Here's another crucial point for employers. You can recover these payments. Small employers can actually recover 103% of the SMP or SPP they pay out. This is claimed via the EPS and provides a really significant cash flow benefit, so don't miss out on it. Now, let's talk about pensions and auto-enrollment. This is a legal requirement for all UK employers. You must automatically enroll eligible staff into a workplace pension scheme. The minimum contribution rates are currently set at 8% total, with the employee contributing 5% of their qualifying earnings and the employer contributing 3%. It is vital to ensure your payroll software is configured correctly to assess all your staff for eligibility and calculate these contributions accurately for your chosen pension scheme. So, as we look ahead to April 2025, what key changes should we be watching for? These are usually announced in the spring budget. Will the personal allowance and national insurance thresholds remain frozen, or will they finally increase with inflation? Will the tax rates for the UK or for Scotland be adjusted? And after the cuts we saw recently, will the main rate of employee national insurance see another change? Always stay subscribed to HMRC alerts to keep up with any new requirements. So that was your deep dive into UK payroll for the 2025 to 2026 tax year. Understanding these elements, income tax, NICs, RTI, statutory payments, and pensions, is essential for accurate and compliant operation. The main takeaway is this: use the current 2024-2025 rates for planning, but always update your software with the final official HMRC figures as soon as they become available in early 2025. If you found this breakdown helpful, please hit that thumbs up button. What's the biggest payroll challenge you face? Let me know in the comments below. And if you want to stay ahead of all the UK payroll and finance changes, hit that subscribe button and ring the notification bell. Thanks for watching, and I'll see you in the next video.